Hey everyone, it's Imran from Options Insight with your macro options spotlight. Okay, so stocks in the US drifting a bit yesterday. Waller's comments weighing a little bit on the short end of the rates market, but then they were counteracted by Brainard, who is known to be a bit more of a dove. So the market did have a little pop up to 4,000, but then in the last hour of the session, it got sold back down to finish nearly 1% on the day. So not really sure what's going on there, but it seems like that 4,000 strike that we've been mentioning, which is quite a big strike for NOV OPEX, looks to be providing a bit of resistance right now. And we're back up there actually as we speak. We have popped again back to that strike level. Let's see if we manage to break it. I would favor we probably struggle to break it into before Friday. Now, if we switch over to what China's been up to, continued strength from China overnight. Chinese stocks really ripping, and that's despite poor industrial production data and retail sales data out of China, obviously impacted by what they've been doing with regards to COVID restrictions. But the market doesn't really seem to care. Chinese stocks ripping again, Hong Kong up 3 to 4% as well overnight, as Xi and Biden met yesterday, and it seemed like they got on relatively well, and they were talking in a way that was de-escalating or wanting to de-escalate tensions. So you see the semiconductors have been flying on that as well. The idea that they're going to maybe ease some of the restrictions there in terms of imports of semiconductors into China. If that is the case, certainly the equity market seems to like it in China. But in terms of a reopening story, if it was the reopening story, then we'd be seeing strength out of the likes of oil and copper, which we haven't. So we've seen oil down 3% yesterday. We saw copper down 2%. So that weakness there it's been said that it's partly because of COVID cases in China, but also OPEC did come out and talk about their demand forecasts, and they have lowered those going into next year. So if we were to get a full-scale China reopening, then OPEC would likely then reverse course and know that the demand was a lot higher. But at the moment, they're justifying the recent production cuts that they've done in the face of what Biden was asking for, and therefore they're lowering demand because that's more consistent with what they're doing in terms of supply. If we then look, but in terms of the spot price action in oil, personally, I think accumulating oil into any dips between now and say the end of the year is probably a decent trade for the first quarter. Okay, if we look at vols popping in US stocks, even as the moves were relatively muted. So we only saw a Sigma move on the day of like half a standard deviation, but we saw vol popping, so up 2 vols in terms of the at the money 1 month stuff on S&P and NASDAQ. So maybe some sellers fatigue there. Absolute levels did start to look quite low in volatility, especially if you look across at how these things are carrying with massive realized vol that we've seen so far. There may be a window of calm, however, as we head into OPEX. If we can't break this 4,000 level and there's no immediate bearish catalyst, then we may find ourselves stuck in a bit of a range into Thanksgiving. But then obviously our early December is where the fireworks potentially going to start again. So I'd be careful of selling too much volatility or at least staying short volatility into the end of the month. If we look at skew, most equity indices are sitting very low still in terms of skew, all in the single digit percentiles. It looks like Russell, Eurostoxx and FTSE are screening as the lowest. Asian skew also taking a hit with China and Japan skew softening by about half a vol yesterday. Okay, if we move over then to the other asset classes, we can see the dollar did stabilize a bit yesterday, where you can see euro was at 103, pound at 117.5. That has popped again back above 118 though, the pound, and euros at 104. So dollar coming under pressure, that 105, 106 area in DXY coming under attack. Let's see if it can hold it there, but that's a pretty huge level. And the dollar has already seen quite a lot of weakness and does feel a little bit oversold in the short term. I wouldn't be surprised to see some sort of bounce. We have got inflation data in the UK, and we've got the fiscal statement on Thursday. That's going to be big for the pound. So watch out for some volatility there. And dollar yen having a bit of a bounce, looking pretty oversold as well yesterday as a weaker yen on the back of some Japanese data that didn't come out too great in Japan. Okay, so that's what we saw in spot-wise in terms of FX. Bonds drifting a little bit as well. And in terms of the sectors, ARK was down 3.7% after having a ripping 2 days of 23% rally. It gave a bit back, which is just kind of run-of-the-mill to be expected really after such a sharp rally. FX vols starting to firm up a little bit. Obviously, they had been hit despite the really high realized on the upside. They are starting to see some bids come back. Not a massive surprise. Bond vol also bouncing as well with TLT back to 20 vol. Did look a little bit oversold, as I'd kind of mentioned yesterday. And sectors also starting to see some bids come back in vol terms as well across the sectors that I'm tracking. So just in general, if you were short a bit of vol, you did pretty well over the last few days. Looking at how things are realizing, it might make sense to cover some of those shorts and bank some of that profit, basically. So that's probably what we're seeing. No real change in terms of carry, red across the board. Expect that to remain for a couple of weeks as these numbers work their way through. If markets do manage to stabilize, but that's a big if. But we do think Thanksgiving does give us a window of opportunity to establish a bit of a range. But then, like I say, early December is where the fireworks start. So you're probably going to see some buyers come back hunting some cheap vol towards the end of the month. Little to report on skew in terms of FX. ARC skew did catch a bit of a bid as spot fell over 3%, suggesting that maybe the short squeeze is going to take a pause here. And XLF skew is actually screening quite cheap as well if we look at the sectors. If you think those banks have moved a bit far too fast, they've had a very decent rally in XLF. I remember before earnings, we put on some bullish plays, and I think they're up best part of 20% since then. If you wanted to fade that, then I think risk reversals in XLF are looking quite interesting again. Okay, now if we have a look at what's going on this week, retail focus. So the big data point in the US is going to be US retail sales tomorrow, expected to increase 1%, which if confirmed may signal a stronger than expected consumer and contradict some of that slowing inflation data that we've seen suggesting demand destruction. Okay, so that narrative maybe takes a bit of a hit if retail sales come in strong. Walmart and Target earnings are also due. Walmart's tonight, and I think Target's tomorrow. Implied moves in the options market for those names are 5.5 and 9.2% respectively. Likely weak expectations. I do see some room for upside surprises. The issues of large inventory builds that we saw in stocks, saw those stocks tank back in May on previous earnings reports have likely been resolved. And so key data will be around margins and if these higher prices have been passed on to the customers or not. The outlook for the coming holiday season is also going to be watched closely, but the robustness of the labour market so far should prevent things from looking too gloomy, and that's really a story more for next year when the recession hits. But in terms of inventory to sales ratios and things like that, they're below the 2020 levels, so we don't think there's going to be this massive overhang that these retailers are going to suffer from. And you can see here in the chart, they had those big drops down in May of 20% apiece. Walmart had a decent quarter last run and ripped 10%. Target was still pretty weak though, but I do think there's room for these stocks to continue to recover because it doesn't seem like the consumer's completely fallen out of bed just yet. Okay, then let's move over to cable, or the pound sterling, as it's also known. We do think that's benefited a bit from the dollar weakness, and we don't think it's really reflecting the risk to the UK economy. So on this chart, what I've laid out is the 2-year yields in the US and the UK. And if we go back, if we rewind a month and see this big puke that happened, obviously on the back of what was going on with the Truss government, those yields were kind of in line with each other, right? They were hanging in the low 3%. So then obviously as confidence was lost in the UK government and the whole bond market collapsed in the UK, we also saw yields skyrocket in the US as well. But for a brief period of time, UK yields were trading above the US by a reasonable margin. So since then, we've seen a collapse. Obviously, Rishi's come in. We've seen a collapse back down into UK yields, back down to that 3.16 area in the 2-year, whereas US yields, as you can see, after their ascent, have kind of stayed at that top, near the top of the range at sort of 435. Obviously, they got a bit higher. They pulled back 50 bips recently, but in terms of the differential between UK and US yields, it's widened quite significantly, right? With UK yields over 1% below what we have in the equivalent in the US. So, normally when you see that wide yield differential, you would have expected some weakness to come back in the pound, but you can see the pound is just sitting there at its local high right now at 118.5. So we think there's room. That's also a technical level of resistance right now. If we look at some of the retracements of some of the move that we've seen down over the last few months. So we do think 118.5 presents a reasonable entry point to fade this rally. We do think you're probably going to get a high inflation print tomorrow. Then the fiscal statement is going to come out, and we do think the Bank of England's hands are going to be a bit tied, and they're not going to be able to really hike that aggressively to get inflation in check. because of what's going on in terms of the broader economy. So on that, we do think cable's a bit of a fade. So what would we do about it? So we will have first we'll have a look at our volatility dashboard. So this is our dashboard that we send out every week. Once a week, our weekly subscribers get this dashboard for every single asset that we look at. This is a full kind of snapshot of everything we look at for each asset. So you can see here, spot wise, we do see we've smashed up through the top Bollinger Band. So obviously we're on the right side here on spot because spot's expensive. Volatility has retraced quite a bit, as you can see here, but it is still elevated on a 1 to 1.5 year time frame. So that's why vol is still elevated, which is suggesting selling vol better than buying vol. I personally don't agree with that, because you want to see a confirmation. When vol is elevated, you want to see how it's carrying. In terms of how it's carrying negatively. So that's saying realized volatility is significantly higher than these levels have implied. So whilst we've got a realized of around 26, 27 and only an implied of around 13, that's giving us a massive negative carry, which is going to make it hard for implied volatility to collapse in the next week or two, because this thing's moving around so much. And we expect with the catalysts on Thursday, it's probably going to continue to move. Okay, so we don't really like selling calls in cable. What we do like doing is just buying outright puts. We think looking at the skew has collapsed and pretty much given back most of its premium. So it's no longer trading at crazy elevated levels. It's 1.5 vols over for puts, which we think is reasonable, because I think the pound does still have a lot of downside risk given the state of the economy and what it's facing next year. So on the back of that, we think vol has, if you look from a last month ago, vol has corrected quite a lot. We think that 1 month vol at 13 and the fact that the skew has retraced makes downside puts in the 1 month look reasonably good value. So the trade that we are looking at is, all right, that's it for today. Thanks for listening, everyone. And I'll see you tomorrow.